Good morning, everybody. Good morning and happy Tuesday. Hope you all can hear me okay. All right. Perfect. Very good. Let's get started. Again, good morning, everyone. It's Serge Berger here from thesteadytrader.com here on this Tuesday. Today, of course, is the 4th of November. And we're looking at, some risk-off movements here that, may or may not be long overdue. And I think it's important that we walk through this, quite systematically to understand, how much further, sort of risk assets could fall. I'd like to, we'll go through our notepad here, but I think the first thing I'd like to do is just reiterate that when I talk to people about how they're positioned and what they think markets will do from here until the end of the year, there's maybe 10% of people that I find, maybe 15%, that are not ridiculously bullish. The narrative, and I understand why, trust me, I talk about this a lot. I've talked about this for years and years and years, that the fourth quarter can be very positive. However, it's not a sure thing, right? It's not 100% guaranteed. There's several years I can point you back to where we had crappy fourth quarters. Not every single day, every single month in the fourth quarter, not like all of October, all of November, and all of December, but as a whole, right? Start to end. And I think people are not really giving that a real chance right now. Again, I'm not saying it's going to happen, but I look at risk assets and I have to say there's probably some indigestion here that has a pretty good chance. And quite frankly, we've been pointing it out here and it's so far been right. You look at Bitcoin, which is a great barometer of liquidity and basically risk appetite. And Bitcoin is now the same level where it was, in pretty much almost 12 months ago, not quite, but let's say December of last year. So that's, 11, it hasn't done anything. And so, look at that and I just have a hard time imagining that, people are going to be happily piling into 7 stocks. Valuations be damned, meaning they're not that horrible, right? I mean, NVIDIA's get a 4P of 35. That's not crazy, right? But there becomes a concentration issue in the market. So this is not, I don't have a fundamental problem with these companies, although, Meta issuing a lot of bonds, for example, is changing what the capital structure looks like on the balance sheet. That's a very different company than it was, for a long time now. But that's not really my concern. My concern is the market cap concentration and how that can lead to algorithms basically causing quite a bit more volatility than I think people are bargaining for. So that's what's going on there. So in terms of year to date, though, just as a quick reminder, because we do this every single morning, just a reminder that yes, stocks are doing well, right? So you see like the S&P is up, almost 18%, actually well less now, of course, because we have a bit of a down move or so far this morning. The NASDAQ 100 up 24%, doing very, very well, but nowhere near as well as hard assets like gold, like silver, like some of the mining stocks, right? So that's important to keep in mind that continues to play out. That has not changed. Just because gold's in a consolidation phase, that has not changed. Consumer stocks, and I pointed this out now for, I don't know, I'm going to say a couple of weeks or so, and I pointed it out again yesterday, are looking concerning, right? So we talked about the consumer yesterday, and, I look at something like Starbucks, which to me, I look at a company like Starbucks and I look at it through the lens of trend following, right? So Starbucks, from our trend following work, if I could properly type in ticker symbols, was in a bullish trend, went through a neutral trend and is now in a bearish trend. We actually even have bearish momentum here this morning. So if you're using the trend or momentum indicator, you're going to receive a signal on Starbucks this morning. So check your email. But my real question is, with the consumer really weak, again, we talked about it yesterday. We talked about consumer-facing stocks, even like consumer staples, right? We talked about a lot of them being down 30% on the year. So some of them down as little as 10%, some of them down as much as 80+%, right? That's not the kind of thing that I want to totally ignore, right? I think that's really kind of where, where I come down in all of this, is that this bifurcation in the market can lead algorithms to pick up, and raising some cash. And again, it's not because fundamentally we dislike Mac 7 stocks, but the constellation of the concentration can lead to issues. So my question is, could Starbucks, for example, go the way of Chipotle Mexican Grill, right? CMG, which is the blue line on your screen, right? I don't know, but I do know that Starbucks is the line at the top. Chipotle Mexican Grill is the blue line at the bottom, right? And so I do know that Starbucks, they're both consumer-facing stocks. So I have a hard time imagining that people are going to continue drinking $7 lattes at the same rate as they have in the past, but giving up on burritos. I just don't think that's going to happen. But maybe I'm wrong. So I would argue there's a decent chance that we're going to start to see something like Starbucks crack a little bit as well. And I think that'll be interesting to see how markets react to that. And again, we're going to be very systematic on this. Starbucks is now bearish trend and has bearish momentum. Earnings are out of the way, so we'll see how people hold up here through the holiday seasons. Remember, Starbucks has an important quarter here in the fourth quarter due to the holiday beverages like the pumpkin spice lattes that we all like so much, or at least I do. I think I've only had one so far this year, so I may have to have another couple just to keep up my my annual rate on that. But I think that's something we need to keep in mind, is that these stocks are not acting well. Now, that's just one part of the story here. Let me go in and kind of show you a little bit what happened yesterday. So yesterday we had some pretty interesting price action or happenings in the bond market. The high yield market, HYG is the ETF, arguably outside of the big drawdown in April, hasn't done anything since basically September of last year. So for more than a year. And it's been in a very notable trading range, let's call it, certainly since August, maybe even a bit before. So I think that's something that we need to keep in mind, is that the high yield market is starting to look a little bit. There's a lot of supply coming coming to market, so that's something that we want to be mindful of. And quite frankly, a lot of this, and this is really what we've been talking about for some time now, it's the dollar index. I don't know if you guys remember, I've been talking about it here endlessly every morning for the past month and a half, probably more, is that we thought that the dollar could start to rally, right? We talked about it again yesterday morning. So if you're paying attention, hopefully you've heard me say this, and the dollar, it's once again up this morning. And so the question is, if the dollar is up, what does that mean for stocks that have largely had essentially an inverse relationship to the dollar year to date because of because of the debt monetization? So I think this is an important part to understand. So I'd watch the dollar very closely. I wouldn't at all rule out that algos come in and start buying every dip again literally this morning. It's possible, but the risks are there that they don't. And so I think from a risk management perspective, this is something that I would keep in mind, right? But again, it's important to stay open-minded here, and the best way of explaining all this, of being open-minded here, is because we're not really in a normal cycle, right? We have a very different economy now than we had for the past 15 years in the United States. It's a very business-friendly economy. And I'm not making political statements. I'm just looking at factually deregulation and that kind of stuff, right? So we have a very different environment where, they're looking for lower rates, potentially bring their whole yield curve down, looking at lower rates also for smaller companies, for the consumer. So it's a very different economy that I think we have to be open-minded to either certainly for further continued bullish outcomes, or, my bearish concerns is much more around the structure of the market, the crazy concentration of a few stocks on the index level. And so a lot of people are mistaking, a few stocks bloating the market higher with skill. I see it a lot, sadly, also in some of our members' areas, where people can't even imagine stocks going down for more than a few days. And if they do, they typically lose a lot of money because they're positioned only in one way, and they're mistaking all sorts of option strategies for skill, when really they're just, playing the market going higher. So my concern on the bearish side is not so much the economy falling apart, although we certainly are seeing weakening of the consumer, as I just pointed out before. It's much more structural in nature, right? So quantitative analysis from a algorithmic perspective and all those kind of things is really the bigger issue in my view, and that can cause real issues, right? And that could then even snowball into some of the perma bullish strategists ultimately turning more cautious. It doesn't have to go that way, but it can, right? And so I think there's a big difference between saying the economy sucks versus there's a lot of very concentrated risk on the index level on the S&P. So those are two different things, but again, I think I'd be open-minded to changes there in the market as far as that's concerned. So we've talked about Bitcoin. We've talked about how it's underperforming, which we could see tech stocks follow that a little bit. We talked about high yield bonds having a pretty notable move yesterday. Nothing catastrophic, but something just to keep in mind. Right. We talked about UUP, and the last thing I want to do before we actually, I want to look at the S&P. I want to give you a technical take on it here in a minute, because I think that's something that a lot of people are looking for right now. I would like to just quickly point out that we're in our educational session this week. We are talking about extreme market moves, extremely overbought and extremely oversold. And my colleague Christian, who's here, he posted the link for this educational session this week in the chat box there. So if you want to join us and learn how we find extremely overbought and extremely oversold stocks to take advantage of basically people's emotions, right, or the market's emotions, you can join us for that. It's completely free. It's this week's educational series session. And again, the link for that is in the chat box here on YouTube. So if you want to join us for that, we'd love to have you there. Just make sure you register so that you can get the email sent to you for joining. Okay. Lastly, just real quick on the S&P 500, there is a possibility that what we saw the other day was an exhaustion up gap on the 27th of October. So this would have been last week on Monday. I'm seeing some people talk about this a little bit, and I think it's important to keep in mind what you're looking at here is the futures contract of the S&P, because it already has today's price action. If I showed you the SPY, it wouldn't have it because, U.S. markets aren't open yet. But there is the possibility that it was an exhaustion gap to the upside, which would mean that we could now slip into a consolidation phase, right? Now, how deep is that consolidation phase? Just to kind of put this into perspective, I'm going to say at the very least, a pullback here would probably be healthy to get us back to, say, that yellow line. The yellow line is it's the blue line, it's the 50-period moving average. You can see it's been holding very well, ever since we broke above it in May of this year. I would argue that a bit even healthier would be for us to get down to, the next level, which is closer to the 100-period moving average. And maybe even better than that would be if we get down to the 200-period moving average. The 200-period moving average from here is about another 9.5% lower. That seems unfathomable. I know, I get it. 15 years of a bull market will tend to get us think that way. But I do want people to stay open-minded, because only being open-minded is going to allow us to be nimble enough to change direction, right? There's a record amount of people that have it as their base case that we're going to see a fourth quarter rally. It is still my base case too, but I'm open-minded enough and hedged enough to be open that this rally may be done for the year, right? Again, it's not my base case, but I'm assigning about a 40% chance to that. I do think there is a reasonable chance that happens. 40%, 60% chance that we continue to see a melt higher and dips getting bought. So anyway, hope that helps, folks. We're going to wrap it up here and move on over to our Market Rover member session, which starts in just a couple minutes. So I hope to see all of you guys that are Market Rover members over there. And yeah, that's it for here today. We'll see you guys back here tomorrow as well. Be well. Please give us a thumbs up, like on all the videos, leave a comment, and please subscribe to the channel. It's totally free. And see you guys back here tomorrow. Thanks for joining.